Hello, good afternoon, and welcome to this webinar all about self-assessment. My name's Emily Coltman, I'm FreeAgent's Chief Accountant, and I'm here to give you some top tips for completing and filing your self-assessment tax return for the tax year that finished on the 5th of April this year, which we call 2024 to 25. Just a couple of housekeeping points. I am going to be talking about old-style self-assessment today, the kind of tax returns that if you've been in business or you've rented out a property for a few years, the kind of tax returns that you will have been doing on an ongoing basis. I'm talking about today the tax return that covers this period here, which we call the tax year 24 to 25, from the 6th of April 2024 to the 5th of April 2025. What I'm not talking about today is the new rules for making tax digital for income tax, the changes that are coming in from April 2026. I'm not going to be talking about that or about the quarterly updates that you need to make or the final declaration. This is all about the old style self-assessment tax return that needs to be in by the 31st of January 2026. If you would like to know about making tax digital for income tax, then please head on over to our events and webinar recordings page on the FreeAgent website. You'll find recordings there of 2 recent webinars about making tax digital for income tax to help you get ready. One is for sole traders, the other is for landlords. So please have a look at those if it's making tax digital for income tax you're not sure about. We do also have on the FreeAgent website a Making Tax Digital hub with lots of helpful content about making tax digital for income tax. So again, today's webinar is about the old style self-assessment tax return, not about making tax digital for income tax. And the other housekeeping point is that I'm afraid I won't be taking questions from the floor today because there's just too many of you here. And also because we're not insured to provide tax advice, so I can't advise you on how to fill in your own specific tax return. I can only provide you with some top tips and general guidance, which is what I'm going to do in the next half hour or so. I'm a qualified accountant, but please don't hold that against me. I've been working with small businesses since the year 2000, and I've filled in plenty of tax returns in my time. So what I'm going to do today is to kind of talk about the most common traps, pitfalls, the most common questions that people ask when it comes to filling in a tax return, and hopefully that will help you when it comes to doing yours. So as I've said before, the tax year, or fiscal year, you might also hear it called, runs from the 6th of April one year to the 5th of April the following year, and it's due for filing by the end of January following that 5th of April. So you've got till the end of January 2026 to file your tax return for the tax year 24-25, so long as you file it online. If you wanted to file your tax return on paper, I'm afraid you've already missed the train. The filing deadline for that was the end of October 2025. So you will need to file online now in order to avoid a £100 penalty. And that £100 penalty, by the way, is for late filing of your tax return, not for late payment of your tax. Doesn't matter if you've already paid your tax, doesn't matter if you don't have any tax to pay. If you're late filing your tax return, you will get fined £100. You can appeal that and get the money back if you can convince HMRC that you've got what they call a reasonable excuse. Reasonable excuse might be sudden illness, sudden bereavement in the run-up to the filing deadline. It might be a natural disaster. For instance, I used to live in Cumbria, and one year there was some very bad flooding in Cumbria and lots of business properties were badly damaged. HMRC said they would not issue penalties to people who lived in certain postcode areas which had been flooded out. So if you've got a reasonable excuse, you can ask HMRC to cancel the penalty. No reasonable excuse, then I'm afraid it's a £100 fine if you don't get your tax return in by the end of January. The structure of a tax return is the same for everybody who has to fill one in. You typically have to fill in a tax return if you've got income that HMRC don't already know about. If your only income happens to be salary from a job, then you may well not have to do a tax return at all. For instance, I don't. All my income comes from my work here at FreeAgent. I'm a salaried employee, and so I don't have to do a tax return because HMRC already know about all of my income that I get through FreeAgent because as an employer, FreeAgent has to file reports each time it pays its staff. So it's typically only if you've got income that HMRC don't know about that you've got to do a tax return. So you might, for instance, be a sole trader, otherwise known as self-employed. You might possibly rent out property. You might possibly be in partnership. You might be a minister of religion. You might have sold certain large assets and need to fill in capital gains tax pages. So I say filling in pages. The structure of a tax return means that everybody who has to do a tax return will fill in this section here, the main return, which includes common forms of income and common tax reliefs like bank interest, dividend income, and tax reliefs such as if you pay into a pension. That'll be dealt with on the main return. And then you do what we call supplementary pages for any other income that you might have that doesn't go on the main return, such as income from a job, income from a business, income from a property. Why, you might ask, do you have to put income from a job on your tax return when HMRC already know about that from your employer? The reason for that is that your tax return is designed to give HMRC a picture in the round of all of your taxable income. They want it all reported in one place on your tax return. And they will cross-check the figures on your tax return against your employer's records of your salary. So if your employer paid you 50,000 and you put that in as 5,000, HMRC will notice because they will cross-check. So what I'm going to do now is to step through the main return and some of the supplementary pages, and we're going to look at some of the most common queries that crop up when people are filling in their tax returns. I'm using my FreeAgent account just purely as an aid memoir and a visual aid here. This is not a sales pitch. I might possibly in passing mention some good things that FreeAgent does, but this is about sharing how to fill in your tax return, some top tips and guidance. So the first thing I'd like to draw to your attention is what tax rates are you subject to? Where in the UK do you pay tax? And that might be the rest of the UK, as in England and Northern Ireland. It might be Scotland, it might be Wales. And that depends on where in the UK you live. For instance, you can probably hear from my accent, I'm English, born and raised in England, but I live in Scotland. And because I live in Scotland, I'm a Scottish taxpayer. That means that when I pay my income tax, it's worked out using the Scottish rates and bands, which are different from those that operate in England. Let's have a look at some of the more common types of income that you receive that might well be included on a tax return. So I'm going to start with interest that gets received from the bank, because lots of us get that. What you would put in here is the bank interest that you were due to receive during the tax year. When you're filling in a tax return, you put income that you received or were due to receive during the tax year. It's always the period covered by that tax year, the 6th of April to the 5th of April. Your bank should give you a certificate of interest to say, this is how much you should put on your tax return in respect of interest paid on your accounts. By the way, this is interest that the bank pays you. You unfortunately cannot then take off interest that you had to pay the bank or bank charges. You need to include just what the bank paid you by way of interest here. When you're filling in these boxes, if you've got a joint bank account with, say, your spouse or your partner, put your share. So if you've got a joint bank account, that's likely to be a half share of the interest that you earned on that account. If you have the kind of bank account that's not subject to tax on the interest, so an ISA or an old style TESA, those you leave off your tax return completely because they are not subject to tax. If you are a sole trader and you've got a separate bank account for your business, don't fall into the trap of putting your business interest onto your self-employment pages where you report the rest of your sole trade income. Your bank interest counts as your personal income and it goes here on your main return. If you're operating your own business but you've got a limited company, the interest that the company receives on its bank account goes on the company's tax return, not on your tax return. This is your tax return. You don't put the company's income here. If you're operating a limited company, you're likely to fill in employment pages to show your salary from the company. You will also almost certainly have some dividends that you've received on the shares you hold in your company. You report those here on the main return, along with any other dividends due during the tax year that you might have a portfolio of shares for investment, for instance, you would put those here. But anything else that relates to a limited company, if you're operating your business that way, the company's sales and costs and capital allowances and what have you, those go on the company's tax return, not on your tax return. This is your tax return. Remember that it's your income that you put here, not the company's. Don't make the mistake of putting your company's income and costs on self-employment pages on your tax return. Those you only use if you are a sole trader. You don't use them if you're operating a limited company. To come back to the dividend income, even if you don't have your own limited company, you might well have some dividends. You might possibly have a portfolio of shares, as I said earlier. You would report that income here on the main return section of your tax return. Pension contributions are quite an interesting one. You only need to put those on the main return if you're what's called a higher rate taxpayer. So you pay some tax at 40% or above on some of your income. And the pension scheme is what's called a relief at source scheme. If you're not sure what type of scheme your pension is, have a look at the paperwork that your pension company give you. But as I say, you only need to fill that box in if you're a higher rate taxpayer and you've got a relief at source pension scheme. If you're a basic rate taxpayer, or if you've got a different kind of pension scheme like salary sacrifice, the tax relief will already have been dealt with outside your tax return, so you don't have to put your contributions in here. Charitable donations, there's a bit of a gotcha here if you are what we call a non-taxpayer. In other words, if you're not earning enough to pay income tax on what you've earned. When you give a donation under gift aid, you always have to fill in boxes to say, yes, I've paid enough tax to cover what the charity is going to reclaim. Because how gift aid works is, you make a donation out of income on which you've paid tax. The charity then reclaims the tax that you've paid on that donation. If you did not pay any tax, and therefore the charity has reclaimed tax that was never paid, you are actually supposed to make good that amount of tax. So you would need to put in your gift aid payments here. If you're a higher rate taxpayer, they'll reduce your tax liability. But if you're what we call a non-taxpayer, in other words, you haven't earned enough to start paying income tax, they will actually give you a tax liability, because that is you making good the amount of tax that the charity has reclaimed. Watch out for that. Student loans, this is quite an interesting one. If you are repaying a student loan or a postgraduate loan, let's say it's a student loan, you may or may not have had student loan deductions taken by your employer. If you have a salaried job and your salary is high enough in its own right to go over the student loan threshold, your employer will have already taken some contributions to your student loan off your wages. You put those in there. Suppose, on the other hand, that your salary isn't high enough to go over the student loan threshold. Suppose you have a limited company and you're taking a very small salary and you're paying the rest, taking the rest from the company by way of dividends. You won't have had any student loan deductions taken off the dividends when the company declared them to you, but you are going to have to pay student loan deductions in respect of your dividends. You only fill that box in if you've had deductions taken off your salary by your employer. If you've got other forms of income like dividend income, or if you are self-employed, you might have enough income from that to take you over the threshold. In that case, you wouldn't put anything here, but the contributions would be worked out when you pay your tax. So that's what I wanted to go over on the main return. Let's look at some of the supplementary pages and address some of the common gotchas there. The supplementary pages for employment, as I said before, even though HMRC will already know about the income that you had from your job because your employer will have told them, you still need to fill in employment pages on your tax return to include that income there, because your tax return is all about giving HMRC a full picture of your income in the round. If you had more than one job during the tax year, during that period, the 6th of April to the 5th of April, do a set of employment pages for each employment. Don't try and add them together, otherwise your tax might end up incorrect and your national insurance might end up incorrect. You need to do a separate set of pages for each employment that you had during the tax year. If you were still employed by that employer on the 5th of April 2025, your employer will have given you what's called a Form P60, which says how much you earned in salary and how much tax was taken off your wages during the tax year. And that's what you need to use to fill in your tax return. If you left your employer before the 5th of April 2025, you'll have instead a Form P45, which has the same information on it about how much you earned and how much tax you paid. Don't get confused thinking you should have a P60 if you left before the 5th of April. You won't, it'll be a P45. Similarly, if you left the employment on the 6th of April even, you should still have a P60 because you were still employed on the 5th. You would use your P60 or P45 and then what we call a Form P11D to fill in the rest of the employment pages. A Form P11D explains the values of any non-cash benefits that you received from your employer on which tax is due. For instance, private medical insurance. Not all non-cash benefits you receive from your employer are taxable. For instance, if your employer's got a canteen that serves all its staff and you pay a reduced amount for meals at the canteen, so long as everybody who works there gets the same benefit, it's not taxable. So as I say, not all benefits are taxable. If they are, they'll be on your P11D and you need to add them to your tax return. Why do you need to add them to your tax return? Because you will have paid more tax because of them. And if you don't tell HMRC why you've paid more tax by putting in those values, then HMRC will say, this person's paid too much tax, we'd better give them some of it back. And while that might sound good, remember what I said about HMRC cross-check their records. They will discover that you had a taxable benefit and they'll go, we shouldn't have given that person that refund, please give it back. So make sure to be accurate and put in your benefits from your P11D. The expenses you incurred while doing your job, what that would be if your employer isn't reimbursing you in full for costs that you paid personally as part of your work. So the classic example of that is mileage. Your employer can pay you up to 45p a mile for the first 10,000 miles you travelled in the tax year, and up to 25p a mile for any miles travelled over and above 10,000 if you're driving a car. Suppose you've got an employer who only pays you 20 pence a mile. You can put the difference between the HMRC values of 45p or 25p and your employer's value of 20p. You can put the difference in here and get some tax relief back on the amount that your employer could have paid you according to HMRC. I'm now going to have a look at self-employment. These are the pages that a sole trader would fill in. For sole traders, you've recently gone through what we call basis period reform. Time was when if you drew up your accounts to a date other than the end of the tax year, and by the way, the 31st of March and any dates in between the 31st of March and the 5th of April count as matching the tax year. If you drew up your books to a different date each year, you'd have been used to reporting on your tax return the figures for your accounting year that finished within the tax year. Not anymore. Since basis period reform happened, what you are now reporting is your income and your costs for your sole trade during the tax year. You might have decided to change your year end for basis period reform, or you might not have done. And if you didn't, then what you have to do is you have to apportion your figures from two different accounting years. So say, for instance, that I was drawing up my accounts to the 31st of December every year. What I would have to do is I would have to include from the 6th of April to the 31st of December 2024, plus from the 1st of January to the 5th of April 2025 on this tax return. And HMRC have said you've got to apportion that by the number of days in the accounting periods. You can't just add up what transactions actually took place between those dates, so watch out for that. By the way, this is good news if you happen to be using FreeAgent. FreeAgent will do that calculation for you. It will apportion the figures from your different sets of accounts and put the correct figures onto your tax return. What you might also find yourself having to do if you have an accounting year end that doesn't match the tax year is you might find yourself having to file provisional figures to HMRC at first and then come back and file completed figures once your accounting year is finished. So for instance, if I was drawing up my books to the 31st of December every year, we're still in mid-November 2025. The year 2025, the year to the 31st of December 2025, has not yet finished. So if I want to file my tax return before Christmas, then I would be having to send provisional figures because my year hasn't yet finished. The 31st of December hasn't yet passed. I would have to file provisional figures, and then I would have to come back in January and file final figures once I know what happened up to the end of December. A bit of a pain, that, and that's a reason why a lot of sole traders have chosen to use the tax year as their accounting year going forward. I'd like now, in the last 10 minutes, just to look at some of the common gotchas for costs that sole traders in particular bump into. The first one is this here, the trading income allowance. The trading income allowance, and you also get a property income allowance if you're a landlord, that is a flat rate of £1,000 or up to £1,000 if your sales are less than that amount. And you can use that instead of counting up your actual costs and any allowances you might claim on assets. And you can use that instead to reduce the amount of profit you're going to pay tax on. Now, this business actually hasn't got any expenses, which means I would be very foolhardy not to claim the trading income allowance and reduce the amount of profit I'm going to pay tax on to, there you see, 9,000. But if your costs, your actual costs are over £1,000, you would be very foolhardy to claim the trading income allowance. You can't have both. It's your £1,000 trading income allowance or your actual costs that get used to reduce the amount of profit you're going to pay tax on, because you say, okay, start with your sales, take off your costs or take off the trading income allowance. One away from the other is the amount you're going to pay tax on. You can't have both, as I say, and check to see which is the higher. If your costs amount to less than £1,000 a year, claim the trading income allowance. I would suggest you would be foolhardy not to. If your actual costs come to over £1,000 a year, don't claim it, because you're doing yourself out of some money. Working from home is a cost that I would like to talk about because a lot of sole traders work from home. How much can you claim for working from home? You can either claim what we call a fair and reasonable percentage of the actual costs of running your home. So that would be things like heat, light, phone bills, possibly if you've got a business phone, council tax, mortgage interest only if you rent your home, council tax, as I say, rent if you rent your home. You can claim a percentage, and you can use what HMRC call any fair and reasonable method to work out how much of your cost you think you could claim. So you might, for instance, say, okay, there are 10 rooms in my house. I use one of those rooms 90% of that of the time. I use that room for work. So I will take my costs, divide them by 10, multiply by 90%. That's how much I can claim. Couple of traps there. Water you can't claim. You can only claim the cost of water if you've got a separate pipe for your business and you use a lot of water through that. For instance, if you've got a dog grooming parlour or you've got a car wash, then you'd be okay to claim water. Otherwise, no go. And the second point is, if you are working from home and you are claiming part of the use of a room, I don't recommend having a room in your house that you only use for business, because then, strictly speaking, when you sell the house, that room is a business asset and therefore subject to capital gains tax, even if it's within your main home. Have a room that you sometimes use for business and sometimes use for private use. It must be used for business. It must be wholly used for business some of the time, but don't make it be wholly used for business all of the time. Where I used to live, I used to work from home and my office doubled up as my music room. There was a big piano in the corner. So if a HMRC inspector had ever come knocking, I would have been able to say, that room is not wholly used for business all of the time. Look, there's a piano. Travelling on business, I'd like to address as well. When can you claim the cost of travelling on business? As a sole trader, your journey must be primarily for business. It must have a business purpose as its main purpose. If your journeys are regular and predictable, HMRC might not let you claim the cost of them. There was a case fairly recently, there was a self-employed doctor who regularly travelled to the same hospitals to do his work. HMRC said those journeys are regular and predictable. That feels too much like commuting. No go, can't have it. One point I wanted to make about working from home is there is a flat rate allowance that you can claim instead of having to work out all your actual costs, but the flat rate does not cover all the costs. So watch out for that. We've got some very useful infographics on the FreeAgent website that help you identify what you can and can't claim when you're working from home. What I would say is the rules are also different if you're a limited company director working from home. Watch out for that. Again, there's an infographic on our website. So looping back to the travel point, as I say, the journey must have a business purpose as its main purpose, and watch out for when journeys are regular and predictable. The ethos of self-assessment is that it's down to the individual to work out whether they think they can claim particular costs for particular business purposes. I would say if you're at all not sure about whether you can or can't claim a particular cost, or how much you can claim for business use of home, or how much you can claim for travel, or whatever it might be, your accountant is the person to speak to there. The FreeAgent support team aren't allowed to give you that kind of guidance. That it would be accounting advice, and HMRC are probably unlikely to advise you. All they'll be able to advise you to do is to go and have a look on their website or speak to an accountant. Unfortunately, they won't tell you for certain whether you can or can't claim particular costs unless the case goes to court, because that's just how the law is made in the UK. It's drawn up on the basis of case law. I would just very quickly like to address the point of what taxes you will be paying. So as a sole trader or landlord or as an individual, you're subject to income tax and also possibly to national insurance on your income. National insurance doesn't apply to all kinds of income. If you're a sole trader, you might be used to having to pay what we call Class 2 national insurance. Nowadays, you're treated as having paid Class 2 national insurance, unless your profit are below the small profits threshold, which is £6,725 for the tax year we're looking at, 2024 to 25. Otherwise, if your profits are higher than that, you are treated as having paid Class 2 for the purpose of being able to claim your state pension and other state benefits. There's no voluntary payment of Class 2 national insurance if your profits are above the small profits threshold anymore. Income tax and Class 4 national insurance, if you're paying it, are worked out as a percentage of your income above the relevant threshold, as you can see here. And payment is due by the end of January 2026 in this case. You might also have to make a payment on account at the end of July 2026 if your tax bill is over £1,000. And if you haven't paid at least 80% of your tax, what we call at source, which would be, for instance, when your employer takes income tax off your wages before paying it to you. That's called taking income tax at source. If less than 80% of your income is taxed at source, or if less than 80% of your tax bill is paid at source, then, and your bill is over £1,000, you are going to have these payments on account to make, which are half of the tax and Class 4 national insurance you are going to be paying for this tax year. If you think you might struggle to file your tax return on time or to pay your tax on time, don't just keep quiet. HMRC will issue those penalties. Get in touch with HMRC and explain your reasonable excuse for not filing on time. I talked about reasonable excuses a bit earlier. If you've got one or you think you've got one, reach out to HMRC first. Don't wait for them to get in touch with you. Likewise, if you think you're not going to be able to pay your tax by the end of January, contact HMRC to put in place what they call a time to pay arrangement. That's where HMRC give you longer to pay. They may well still charge you interest for paying your tax late, but you won't get penalised if you've got that time to pay arrangement in place. So don't put your head in the sand. If you think you're not going to be able to file your tax return or pay your tax on time, reach out to HMRC and explain to them why, and get that time to pay arrangement put in place. I hope that's been useful. That's been a very quick whistle-stop tour of the self-assessment tax return and looking to address some of the more common queries that taxpayers have about completing their tax returns. As I say, if you're looking for more information about making tax digital for income tax, if you'd like more information about completing your tax return, as far as we can go, we do our best to provide help and guidance, even though we can't provide accounting advice. Head on over to freeagent.com and have a look there for the information you're looking for. Thank you all very much for your time this morning, and have a good rest of your day.